Hi, my name is Pham, and this is my Finance 451 project. Today I'm going to be doing an analysis on two different industries, 5 companies each, and out of those 10 companies we're going to choose one winner. So the first industry decided to analyze is fast food. We're going to be doing Sonic, Popeyes, Wendy's, Papa John's, and McDonald's. Next is the automotive industry, GM, Ford, Toyota, Tesla, and Honda. First thing I always look at is the economic value added spread. EVA spread is the difference between the weighted average cost of capital and the return on invested capital. We always want a high EVA spread. A high EVA spread indicates that a company is growing, that a company can pay back to give back the return that investors want, plus have a little bit extra over to reinvest back into net present value projects. So we always want a high trending or a high EVA spread. And here's my EVA spread for my 5 companies. Here you can see that Sonic, Popeyes, Papa John's, and McDonald's are doing well. Wendy's has a negative 2.85% EVA spread. And let's go ahead and take a look and see why. So, as you can see here, the WACC, the weighted average cost of capital, is 6.4%. This is the return in percentage of what investors want back on their total investment. So this is what you do. The capital charge is what investors want back in millions. And the way you get that is you multiply the WACC times the total invested capital. You get the capital charge of $201 million. The NOPAT, net operating profit after taxes. This is the money that Wendy's made is $118 million. So they had to return $201 million. They only made $118. So as you can see here, their economic value added spread is negative 2.61%. And so we're going to go ahead and move on to what Sonic is like. Sonic here, you can see that investors want 6.8% return. And you can see that Sonic gave a return of 15.55%. And the EVA spread here is going to be 8.72%. This means that Sonic was not only able to service that return to investors, but at the same time, they were able to make 8.72% extra to grow the company, to expand. So back to the EVA spread, we're going to go ahead and get rid of Wendy's. Now, what's the goal of management? The goal of management is to maximize shareholder wealth. So to measure that, we're going to be using the return on equity ratio. Now, as you can see here, we want to look in positive trends. Papa John's is doing really well from 2010 to 2014, positive trend. Sonic here has a rise and a fall, then a rise. So we're going to go ahead and keep that. They have a good ROE here. And as you can see here, the Papa John's has a drop from 2011 on. So we're going to go ahead and get rid of Papa John's. The return on equity has dropped dramatically. And the same with McDonald's. You can see here that they're just being constant. They're not really changing too much with their return on equity. But you can see here that they're getting lower. So we're going to go ahead and get rid of McDonald's. We're going to get rid of Popeyes. So this is my ROE decomposition. The return on equity is really important. That's the return to our shareholders. But we're going to go ahead and break it down and what drives ROE. So ROE breaks down into return on assets times equity multiplier, which is leverage. Return on asset breaks into profit margin, total asset turnover, asset efficiency. And the profit margin breaks into these 3 right here: tax burden, interest burden, and EBIT margin. We're really only going to focus on these 2 right here. This is how we measure a company's. This is how I measure a company's performance, and these 2 right here are what we pay good managers for right here. We don't care about the tax burden or the interest burden because we don't control the tax code, and we don't control the interest expense. So the EBIT margin, as you can see here, Sonic is doing really good from the start over the next 4 years. It looks like they're having really good sales, or simultaneously having good sales and cutting expenses. Their earnings before interest and taxes seems to be rising here over the next 4 years, 50% since 2010. And then Papa John's right here actually dropped 2010, 2011, and then rose and then stayed consistent for the rest of the 2 years. So we really like Sonic for that. Total asset turnover, can see here that Papa John's is really getting their products off their shelves, and they're making a profit with it. Here it drops and then it rises again. Sonic, it's slow but it's consistent. As you can see here, consistently Sonic has been able to get their products off their shelves and able to get it out there and make a profit off of it. So I really like that they're consistent with their growing total asset turnover. Then we look at the amount of leverage that the companies make. As you can see here, Papa John's is actually begins to take out more leverage 2013 to 2014. So that's going to mess up their ratio. They're slowly increasing the amount of debt that they have compared to equity, and we don't like that. We want to make sure that a lot of the funding comes from equity shareholders. So here, I'm really impressed that Sonic is actually continuously dropping their amount of leverage, the amount of borrowing. But if you remember beforehand, their ROE is also raising as well. So what drives the ROE? These are my two tables right here. And after comparing the two, we like Sonic a lot better. Why? Because the higher EBIT margin, consistent growth in total asset turnover, simultaneously lowering their leverage and raising their ROE. And we're not really impressed with Popeyes because Popeyes, from that last year, they had a little spike in the ROE. You'll see that they also, at the same time, took out leverage as well, so we're not really impressed by that either. The current quick and cash ratio, as you can see here, Sonic is doing pretty good. They have a current ratio above 1, but not too high, so they're not really wasting any current assets. They're putting their current assets more towards making a profit for the company. At the same time, they can pay off their short-term debt. So, let's see. Long-term solvency. Alright, let's see. Sonic is consistently raising in their times interest earned ratio. 3.8 here means they can pay back their debt 3.8 times, 4 times over. So that's really good. Let's see, the market believes that from here, you can see that there is a rise, a drop, and then a dramatic rise here. Here to here, really, really good. The market definitely sees this, sees Sonic as a growth company. And you can see the share price rising from 2012 to 2014, and I think it's going to rise even higher in the future. Market to book value ratio, you can see a drop here in Sonic. Accountants definitely think that for every $1 that shareholders put into Sonic, they can produce a consistent growing amount after 2012, so that's really, really good. Here's the supply chain. You can see that Sonic has 4 suppliers here, and that Sonic has, out of those 4, 3 of them provide more. So just a little, might raise a little red flag here, but just in case, since they only have 4 suppliers, you can see that if any one of those companies were to default by any way, that it could definitely mess up Sonic's profit. So that's just a little heads up. Really impressed with their enterprise value. They're a little shaky here, a little rise, a little fall, and after 2012, their total value as a company actually raised a lot, and that's really good. Now, what does Bloomberg think? You can see here that the current price of Sonic is $28.44. Bloomberg sets the theoretical price at $33.21. So that means that Sonic is undervalued and that it's soon going to raise. So you definitely want to invest your money into Sonic. So Sonic is going to be the winner. Next are automotive industries. The first filter we use is EVA, and the problem is all 5 of my automotive companies are all negative in the EVA department. So we got rid of the 2 that were too far gone. Tesla and GM are gone. And as you can see here, the weighted average cost of capital is way larger than the return on invested capital. So negative EVA spread. They won 6.7% return. They only got 0.08 negative EVA spread. Also notice GM has an extremely high amount of debt, so that's bad, and only 49% from shareholders. So ROE, oops, you can see here that Ford had a drastic drop, drastic rise, little drop. We don't like that fluctuation when it comes to return to our shareholders, so we're going to get rid of Ford. We're going to go ahead and keep Toyota and Honda. So what drives the ROE? Once again, and the EBIT margin, it's a lot. There's a dramatic higher raise with Toyota. Toyota seems to be making more with sales, getting their product out there, and at the same time maybe cutting expenses. They're doing it more efficiently and a lot more than Honda after 2012. So I like Toyota a lot better. Profit margin. Let's see, profit margin. You can see here that Toyota has a higher rise, more dramatic rise in profit margin than Honda. You know, here must have been a problem with the economy or something, but after that, you can see here that Toyota is more efficient with their expenses as well. So total asset turnover, I really like both. You can see here that Honda does have a better total asset turnover. They're more efficient with their assets. You can see here that they're getting it out there after 2012. There's also a rise in Toyota as well. There is no drop. Toyota is just consistent. So the amount of leverage. The amount of leverage has dramatically dropped for Honda in 2012 to 2013. They took out more, and then now they're continuing to drop. Toyota has always had a consistent and always a higher amount of debt, of leverage. So the ROE, comparing the two, the return to shareholders, you can see that at 2012 forward, that Toyota actually has a 403% increase in ROE after 2012, and that's really impressive. That's a lot higher than Honda's return to equity, return to shareholders. So we really like Toyota for that. So that's Toyota versus Honda on the table right there. And we like Toyota just from this table. Higher EBIT margin, higher profit margin. Honda does have that consistent total asset turnover. Toyota has a higher ROA. Honda lowering the amount of debt, a lower amount of debt. Toyota has a higher return on equity, so we're going to choose Toyota for the winner. And as you can see here, for Toyota, their current ratio is above 1, but it's definitely lower. It's 1.07, so that's low. So I'm afraid that they can definitely service their debt, but if anything were to happen, you know, I think that 1.07, if anything bad like inflation or something, or you know, something bad would happen to the company, that they only have a little bit left to pay off that short-term debt. So let's look at their ability to pay off their long-term debt, consistently raising, almost as high as $116.76 for every $1 they have to pay in interest. That's really good for Toyota. The PE ratio, not really looking too good. Their share price is actually lowered. It spiked high in 2012 and it just dramatically lowered. This is not, by looking at this, the market would definitely not classify this as a growth company. So that's definitely bad. The market to book value ratio, at a rise in 2012 here, looks like Honda is doing really good, and it's rising a little slower. So the accountants definitely think that Honda's going to be doing better. The total value of Honda, it's been a little down here, raising a little bit, and then after 2012, the whole value of Honda has actually risen quite a bit, and so that's really good. And these are the suppliers to Honda. They have 281 suppliers, so if any one of these companies were to default, or for some reason won't be able to supply to Toyota, it really wouldn't matter that much, so we don't have to worry about that. Now their current share price is $132.55. Bloomberg sets the price at $120, so it's overvalued. So it's kind of a bad time to have your money in it right now. So that's not good. Now Toyota versus Sonic, I have all their information pulled up here versus each other. And as you can see, the EBIT margin is just consistently high with Sonic. Their ability to make sales and to control their expenses is really good. So it's been consistently higher. We have a drop here with Toyota, and then it's higher. But I like how this is consistent all the way through to return to our shareholders. And the same thing here. As far as being efficient, you can see here that Toyota's having a harder time getting their products out of their inventory and out there to make money, and then they're getting a little better at it, and now they're actually slipping down. Where as far as Sonic goes, Sonic is just really good at not holding on to their inventory. They're really good at getting it out there and making a profit with what they have, and that's really good. I really like that. So as far as debt goes, Toyota has no problem with that. Consistent rise in Sonic's debt. So let's see, they don't have a problem with debt. As you can see here, the return on equity has a rise and a drop in 2012, 2013, and a rise again. And Toyota's return is just consistent and raising slower. So the EVA spread was my last filter, and you can't beat Sonic's positive 8.75%. They're more likely to give you a return with Sonic and to grow their own company than Toyota is to pay back their investors. So Sonic versus Toyota. Sonic has a constant 4-year growth in total asset turnover, EBIT margin, return on equity. Toyota, too much fluctuation. Both have a rise in their ability to pay back long-term loans, long-term debt. Sonic's EVA spread is 8.75%. Really like that. Toyota's EVA is negative 0.04%. So out of the two, I got to say that Sonic is the winner, doing really well. And that's the end of my presentation. I'm Pham.